Good morning and welcome to this month's webinar for the Legal Resource Club. My name is Paul McEnroth. I'm a principal in the Brisbane office of Cleary Hall. Many of you probably know me if you've tuned in before, and I'm going to be the host today, and I'll hand over shortly to my colleague Kimberly. But just to give you a bit of a rundown through the usual kind of intro stuff, I can see there are some comments there that the slides are not opening or they're corrupted. I'll try to work on that while Kimberly is presenting, and I'll try to reshare those. But in any event, the slides will come to you later this afternoon in our feedback survey. So if you don't get them on today, I'll try to get them up there. But if you don't, they will be in the feedback email later this afternoon. So this month's webinar will be presented by Kimberly Barnes, who's a senior solicitor in the Brisbane office. Kimberly, although she works in the Brisbane office, primarily works for Adrian in Sydney and does a lot of Sydney-based work. She does work in commercial, estate and succession planning, and some tax work as well. And she's going to talk today about asset protection for structures and businesses. So I might hand over to her. Thank you.
So hello all. Some of you might have met me, but today we've got our second part of our three-part series on asset protection. So we're going to focus today on trading companies and assets that are held in discretionary trusts. So when we're considering these type of structures that will best protect assets, we want to look at what's going to best protect the assets from claims. And so the focal point we should be looking at is who's controlling these assets rather than the ownership of them. So generally, in many cases, clients have either not received advice beforehand and when they're starting their business, or they don't like the costs associated with having a new structure created when they're entering into a new venture. So generally, a client comes to us wanting to have better asset protection. Ideally, the simplest thing to do is to transfer the assets to a new discretionary trust or multiple discretionary trusts, depending on the assets. Obviously, in many situations, this is quite costly, as we've got to consider the CGT consequences as well as stamp duty consequences. So this session is going to look at what else we can do to minimise that. So today we've got a case study. In this case study, we've got Throw an Axe, who operates an axe throwing business inside of a bar. So the assets that we've got here are retained earnings of around $6 million and goodwill of $1 million. The other entity we're going to look at is the Broadsword Property Trust, and it owns the land the business operates from. And this land has a book value of $400,000 with market value of $1.4 million. There's no debt attached to this land. So now generally our clients' objectives are for asset protection, and that's because they're generally concerned of the commercial risks associated with operating a business. Axe throwing can be quite litigious. There's often deficiencies with insurance policies, and that all creditors sit in priority to the owners. So when we look at the fundamentals of asset protection, we need to have a clear line between the individuals and the entities that deal with the public and where the passive assets and those values accrue. So in order to achieve that, we need to have a look at the strategy and ensure that there's a passive, fully discretionary trust. And when you're dealing with companies, they should be owned by passive trusts as well. So generally, as we sort of foreshadowed earlier, the traditional solution to asset protection is to transfer the assets from the risk entity over to a safe haven entity. But when we're doing that, CGT, stamp duty are a consideration in all circumstances. And when you're dealing with companies, Division 7A, balancing adjustments and bringing trading stock to account are also issues that can have adverse tax consequences. So in order to avoid these, we look at using a secure debt alternative. And this properly implemented will remove the value from the company or the trust and put it over into a safe haven entity. So this sort of structure focuses on the equity or the value of the assets rather than that asset ownership. So this means that the tax costs that are necessary in transferring the assets are minimised, and sometimes or you don't need them altogether. So if we apply this to throw an axe, the assets that are going to be at risk are the plant and equipment, other business assets, and these are generally all represented by the retained earnings. And here we also have goodwill that would be at risk. Due to the nature of these assets, they both require separate consideration. So we'll start by looking at the retained earnings of throw and axe. The use of debt will not deal with the franking credits because you can't use debt. You can't stream those franking credits in association with debt. They can only be used with equity. So what we need to look at is how the franking credits can be used. And so that means we either have to look at restructuring the shares of the company if they're held by an individual, or we can consider implementing a new class of shares. So generally, in correctly structured entities, you have the shares owned by a fully discretionary trust. That company would pay a dividend down to that trust, and that trust would then stream that dividend out to another safe haven company. If the dividend can be fully franked, that's great, but regardless, because we've got throw and axe who'll have a 25% tax rate due to it being a small business entity, and the passive company a 30% rate, there's going to be tax payable on that difference. So if we look at restructuring the shares in the event that it's an individual, we can look at trying to use the small business concessions to minimize any gain on that sale, but that's not always available. Or we can look at using a rollover to try and get the shares out of that company. So the alternative to doing that is issuing a new class of share. Now, what we refer to in these cases are a use of dividend access shares or discretionary dividend shares. So we do need to consider the Taxpayer Alert 2024. It is a very confusing piece of text from the ATO, but we're of the view that properly implemented discretionary dividend shares are still appropriate in the circumstances and can be used as asset protection or for asset protection purposes. So what is the nature of a discretionary dividend share? The shareholders will only have a purely discretionary right to income, meaning that they can only receive a dividend on a resolution of the directors. The shares have no rights to vote, they have no rights to meetings, and they have no rights to capital. Another feature of these shares is that they automatically lose the rights to dividends after 47 months or by a director's resolution. So how are these shares established? Well, it starts off with a review of the Constitution and, if appropriate, amending the Constitution to issue these types of shares. Generally, you're going to need the shareholders' consent, so we always get that before we amend the Constitution. So secondly, after the Constitution has been amended, we'll look at issuing the new shares to the new company. So this new company would have a discretionary trust as its shareholder. And for the purposes of this webinar, we're going to call this new company the Shield Protection. So there's some relevant issues that we need to consider when issuing discretionary dividend class shares. And so those today are the value shifting and tax rate differentiation, which we'll discuss a bit further later on. And the other issues are the debt equity, dividend streaming, dividend stripping, franking credit rules, and Part 4A. Now, when we issue these types of shares, these have all already been taken into account, but I will discuss some of them quite briefly. So we've got the debt equity rules. So our discretionary dividend shares are redeemed for nil consideration or something less than their issue price at the end of 47 months. So Division 974 does not pose a problem as it treats the shares as equity interest. It's common sense to see that the dividends do not have the characteristics that are equivalent to a loan, and any return is contingent upon the economic performance of the company. So that rule doesn't really apply. The second one I'll just briefly touch on is dividend streaming. So the dividend streamings apply where franking credits benefits pass to certain shareholders greater than those passing to other shareholders. So this happens when a fully franked dividend is declared to one shareholder, whereas an unfranked dividend would be declared to another. So obviously these provisions don't apply when all dividends are paid to one shareholder and the dividends are franked to the same extent, which is what we would have in these circumstances. Briefly, dividend stripping is also considered. So this isn't defined in income tax legislation, but has been considered by a number of cases, which I won't bore you with. But essentially, a simple payment of a dividend isn't sufficient enough to trigger the operations of a dividend stripping rule. So again, we've considered this and it doesn't apply in these circumstances. Where we'll give you a little bit more information on the issues is the value shifting rules. So our use of discretionary dividend shares are distinguished from others in the fact that the shares are carefully drafted to ensure that these provisions are not activated. So if we look at these shares, they essentially have no better rights than that of a beneficiary of a discretionary trust. So we've looked at this and we've said that the holder of these shares have no rights to meetings, to vote, surplus and wind up dividends, or even to demand dividends once they're declared. So when we're looking at whether a value shift has occurred, we need to look at the market value of the up and down interest of the shares. So more specifically, the market value has a common law meaning, which asks the question as to what is the value or amount that an anxious buyer, a non-anxious buyer, and a seller would agree to. So when we look at trying to determine the market value of these discretionary dividend shares, we need to look at the bundle of rights that is associated with those shares. And if you look at the shares, they simply don't have any rights. So they're going to have a value that's less than nominal, so you won't activate that market value or value shifting rules. So obviously it's sort of simple to see that they don't have a market value, but when we're drafting those shares, it's quite critical. So the second issue is obviously the tax rate differentiation. So with the introduction of the small business tax rate came changes to the franking credit rules. So the franking credit rules have been modified so the company has access to a small business tax rate, can only frank a dividend to that extent. So this means that there's going to be a difference between the tax rate payable by the company, the new company, as they're likely going to be the 30% entity, and the trading company, who will be a small business tax entity. And at this stage, they have a 25% tax rate. There are things we can do to give Shield Protection a 10% of the voting rights to make it a base rate entity in the company. But if the transaction was ever looked at or in the spotlight, this would look unfavourable. So if we go a bit further onto the tax on the dividends, so Throw and Axe is going to be a base rate entity and can therefore frank a dividend to the maximum of 25%. Shield Protection will not be a base rate entity because 100% of its income is going to be passive income, i.e. its income is going to come from the dividends and franking credits. That means that is going to be tax payable on that 5% of the dividend. Also, consideration needs to be given to the amount of franking credits in Throw and Axe, as if the dividends can't be fully franked, there's going to be more tax payable on that dividend. So finding out those franking credits is quite important. So what's the result of declaring this dividend? So whether the equity interest relied upon is dealing with the existing shares or an issue of new shares, the result in relation to the retained earnings is identical. That's to say, our safe haven entity Shield Protection will be a newly structured company whose shareholder is a discretionary trust and in Throw and Axe, and they will receive a fully franked dividend equal to the retained earnings of Throw and Axe. So essentially, a $6 million dividend is declared to this company. True asset protection can only be gained if Shield Protection takes a secured creditor position over any land, which you could take a mortgage, or any personal property of the company where we use a security interest. The reason these steps are necessary is that in liquidation, priority is granted to secured creditors registered first in time. There are a number of exceptions to this. So this is used if the dividend can't be cash flowed or that the company needs working capital to sort of keep running on the business. And in these circumstances, we'd use a loan back to the company. So as you can see on screen, we've got this end result. Axe has declared and paid a dividend of $6 million to Shield Protection Co. through the use of the discretionary class dividend shares if it was an individual. And Shield Protection Co. has then lent those money funds back to Axe and take security. So that takes care of the retained earnings in the company, but then we need to look at the $1 million worth of goodwill that's on the books. So with respect to goodwill, the value that we're referring to relates to internally generated goodwill and is an amount that exceeds the retained earnings. A similar issue can arise in relation to companies that hold long-term assets, such as real property. So in the present circumstances, Axe will make a gift of $1 million to Shield Protection number 2. So we do have a separate company. Shield Protection number 2 will again lend that money back to Axe on the basis that it cannot be cash flowed. In a similar vein to the goodwill, Shield Protection number 2 will take security over the assets of Axe, whether this be personal property or land, and that will give them that a secured creditor position. So what you can see it looks like on screen, Axe gifts that capital and Shield Protection lends it back. Very similar to our individual asset protection work. So what considerations do we need to look at? So there's a number of issues to be addressed, and that is the validity of the gift, statutory clawback periods, Division 7A, and the application of Sections 44 and 44B of the Income Tax Assessment Act. So firstly, the validity of the gift. So we need to consider whether Axe can use this type of strategy. It's important to look at whether a company can make a gift. Companies have always had the implied power to make gifts, provided that they were not made for the benefit of the company and its shareholders. In addition, the Corporations Act provides that a company has the capacity and powers of an individual, and the legal capacity is not affected by the fact the company's interests are not or would not be served by making the gift. So it follows that the company can legally make the gift, even if the gift is not for the benefit of the company. But directors do have a duty to shareholders, so any gift should be only made with the consent of all of the shareholders of the company. So then we need to have a look at the statutory clawback periods. And these are provisions that are under the Corporations Act. These potential clawback provisions only apply to 4 types of transactions, 5 now. A commonality between 3 or 4 of those transactions, which will be insolvent transactions. And for each provision to apply, the company must either be insolvent or become insolvent at the time the transaction is entered into. So there's 3 types of those insolvent transactions, and that is unfair preference payments, uncommercial transactions, and transactions to defeat or defraud creditors. So as long as we don't become insolvent or aren't insolvent when we make the gift, then it will not be an insolvent transaction and those provisions will not apply. So then we need to look at the unfair preference payment. So if we just look at what those are, an unfair preference payment is a payment made or a transfer of property to a particular credit at a time when the company is about to become insolvent. The clawback period for that is 6 months. An uncommercial transaction is one which a reasonable person in the company's circumstances would not have entered into when it is or about to become insolvent. And the clawback period for this is 4 years. And the clawback period for a transaction to defeat or defraud creditors is 10 years. So gifts by their very nature will almost always be an uncommercial transaction. So the question is whether the gift from Axe is also an insolvent transaction. If it isn't, then those clawback periods won't apply. So that's why it's important that when we're undertaking any type of work, it's important to ensure that those financials are up to date so we don't unwillingly enter into any insolvent transaction throughout this process. So if we have a look at unreasonable director-related transactions, these 2 have a 4-year clawback period. And this is a transaction between the company and a director or his associate or on behalf of any associate. So associates are limited to the relatives of directors and spouses of directors. So this clawback, as I said, is 4 years, but it applies whether or not the transaction is insolvent. So the gift made to shield protection is likely to be seen as a transaction between throw an axe and for the benefit of a director, as shield protection is wholly owned by a discretionary trust controlled by the director. So provided that throw an axe is solvent at the time of the transaction and after the transaction, so this means the amount of the gift is less or equal to the net equity of the company, which on the current facts it is, transaction can only be clawed back within the first 4 years after the gift is made. So we have a relatively new section in the Corporations Act, which is in relation to creditor defeating dispositions. So this has seen the implementation. This was brought on to restrict illegal Phoenix activities. So what is this? A creditor defeating disposition is a disposition of company property for less than its market value or best reasonably obtained price. So this has to have the effect of preventing or hindering or significantly delaying the property from becoming available to company creditors in winding up. So a director must not engage in conduct that results in a creditor defeating disposition if the company is insolvent, the company becomes insolvent due to the transaction, and less than 12 months after the disposition, an external administration occurs, or the company ceases to carry on business due to the disposition of that asset. And that is whether it's indirectly or directly because of it. So a creditor defeating disposition is now avoidable transaction if the disposition was made within the 12 months immediately prior to an external administration of the company. It is again irrelevant whether or not the company was solvent at the time. It's also important to ensure that directors follow these provisions, as there are penalties for the directors personally if they do not. So it's again important to ensure that the transaction does not make the company insolvent, as the gift will be for less than market value. This provision would apply, and it would be able to be clawed back within 12 months, which is still inside that 4-year period. So we also need to have a brief look at Division 7A whenever there is transactions involving private companies. So the two ones that we should have a look at are the one that catches payments by a private company under Section 109C and loans by a private company under Section 109D. But what we see is under 109K, a payment or a loan by a private company to another private company will not result in a deemed dividend under either of those sections. So that means the gift and the loan back from throw an axe to shield protection will not be caught by Division 7A. We'll briefly look at Section 44 and 44B. So 44 is important to address because it looks at the assessable income of a shareholder in relation to a dividend. Dividend is defined as any distribution, so it's any distribution made by a company to any of its shareholders and any amount credited by a company to any of its shareholders paid to the shareholders out of the company profits. So quite wordy there. So dividends as well as profits has quite an expansive meaning. So as you'll see, we used a separate company called Shield Protection number 2 to take that gift from the dividend, and that's to not bring in this section into the work. So Section 44B was brought in relation to demerger and capital benefits. Obviously, here we're not dealing with a demerger situation, and the process we use takes this into account. But briefly, capital benefits is defined as the provision of an ownership interest in a company, the distribution of share capital or premium, and something done in relation to an ownership interest that has the effect of increasing that value. So ownership interest is defined as a share or a right to acquire a share. So because we're not dealing with demerger benefits, and we obviously don't meet those requirements above, this section isn't going to apply to the gift of capital.
Kimberly, I'm going to jump in with a few questions here.
Yeah.
So the first question is, are the discretionary dividend shares purchased?
We have an issue price of them for $1. So they're issued at nominal value. We can decrease that down. So there is that issue price, which is payable.
Thank you. And there was a question there from Mark about a structure diagram. Mark, I had a quick look at the diagram. The diagram I think you're referring to had a discretionary trust in between our operating company and the protection company. That diagram relates to an entity that has a good structure in that a discretionary trust is the shareholder. So it wasn't, it was a little bit before the discretionary dividend shares. The next one, do these additional structures lose some of the small business tax concessions? I might take that one because I've given it a bit of thought. Mark, there was a case in the AAT called Devuba, which talked about essentially that question of whether discretionary or dividend access shares interfered with the other shareholders' ability to access the small business concessions. And in that case, the taxpayer was successful in their arguments, saying that that dividend access shares in that case, obviously each case is a little bit different because it does depend on the wording, and those shares didn't interfere with the small business concessions. We've obviously we've made changes to ours over time based on cases, particularly that one in more recent times. And the next question, Kim, in relation to the 47-month issue, what action needs to take place at that time?
So generally at the 47 months, we just do a redemption of those shares and essentially redeem them, and then we do the ASIC forms to remove them from the register as well.
So that is essentially getting completely rid of the shares. The shares, they have been amended over time. The most recent iteration of them essentially sees them lose their rights to any dividends. So if they don't get removed, it's fine. They can remain there, and effectively they're dormant and invaluable because they have no rights attached to them. So I can't tell you the number of people who have not done that. People ring us all the time saying they've got old shares on issue that they did 8-9 years ago. What do we do with them? The short answer is, as what Kim said, they can be redeemed for nothing.
And just also after that 47 months, the Constitution still has been amended, so it will always have that class of shares there ready to be reissued again, should they still want to continue and use them.
I'll hand it back to you to keep going.
Beautiful. So now we can look at the application and the case study involving the Broadsword Property Trust. So in case anybody forgot from the beginning of the session, this trust owns the land that the business operates from and has a value of $1.4 million with a book value of $400,000. So what we're going to look to do here is protect that equity, and that's going to be by distributing the capital equal to the difference between the book value of the land and the market value. So here we're going to be looking at $1 million. So this is just another little diagram showing what we do here. Again, very similar to the individual asset protection that we do and would have discussed last seminar, and in relation to the gift of capital. So what we're going to see here is Broadsword Property Trust distributing that capital over to a new discretionary trust, and then that being lent back to the trust. And obviously we're going to take that mortgage to give ourselves that secured creditor position. So when we are looking to do this, we've got a couple of considerations that we need to look at. So firstly, that's the potential application of subdivision EA of division 7A and the trustees' powers, and to make sure that they have the power to make that capital distribution. So what is subdivision EA of division 7A? So it's very similar vein to subdivision B, but this division operates in context of trusts that have unpaid present entitlements in favour of private companies. Where this circumstance exists, to the extent that a corporate beneficiary has a distributable surplus, payments and loans made by the trustee or debts forgiven by the trustee to a shareholder of a corporate beneficiary or an associate, will have division 7A implications. So therefore, if any unpaid present entitlements exist on the books of the trust to corporate beneficiaries, we'll need to deal with those before we undertake this kind of transaction. So we'll look at the trustee's powers. So before the trustee of the Broadsword Property Trust is able to make a distribution of capital, a thorough review of the trust deed will happen. And that'll be to ensure that the following are authorised. And if they're not authorised, we'll ensure that the trust deed is varied to allow these transactions to occur. Obviously, we'll also be looking to make sure that varying the trust doesn't trigger stamp duty or capital gains consequences. So what we're going to look for or vary to do is to have the ability to revalue assets and allocate that capital to an account styled asset revaluation reserve. We have to look at making sure that the trustee can make interim distributions of capital to other trusts, ensuring that the proposed recipient of this capital is a beneficiary under the trust, and make sure that the trustee of the Broadsword Property Trust can offer up its assets as security. Now, this has actually been tested in the case of Fisher and Nemski, and it was upheld that the documents affecting this were valid, but I'll briefly run through it. So this case concerned the trustee Nems Family Trust and Mr. and Mrs. Nems. The only asset in this trust was shares. They were revalued to nearly $4 million, and that amount was credited to the asset revaluation reserve. And this was then credited to Mr. and Mrs. Nemes. So upon the death of Mr. Nemes, the High Court essentially held that the trust owed owed the estate that amount of money. So the trust owed Mr. Nemes' estate $4 million. And that was by a majority of 3-2. So importantly, though, the arguments before the High Court were around the form and content of the documents that affected the revaluation and distribution. It was not the substance of the transaction that was in question, and no dispute was taken with the ability of the trustee to use this technique to secure its assets. So that almost brings me to the end. So I'll have a little summary of what we've just discussed. So even though there's a number of considerations that need to be addressed prior to implementing any one of these strategies, if it is implemented correctly, and we do look at those, we do have the ability to reduce exposure to commercial risk, especially where individuals and entities deal with the public. It'll overcome any deficiencies in insurance policies because we protected the value of the assets. It'll elevate a related party to the position of a secured creditor, and that will rank in priority ahead of the owner to the assets. And it does eliminate that transfer costs that are associated with transferring assets, so that stamp duty and CGT. But given that there are potential clawback provisions, it's always better to start this process sooner rather than later, so we can get that clock ticking. You'd be surprised how quickly 4 years can pass, though. And that's all from me.
Thank you, Kim. I had a question about that previous case. I said it was in the AAT. It actually obviously started there and worked its way all the way to the full court of the federal court, and I've put the case citation in the comments field. So obviously that is significant authority if it went all the way to the full court. I think from today's session you can understand that dividend access shares and trust to trust secured debt is a complicated area. I received a private message in the background about what are the accounting entries for making a gift from a company, and that becomes even more complicated because, as you may know, hopefully, the accounting standards don't allow for internally generated goodwill, which is essentially what that process is doing, is revaluing that goodwill figure in order to protect it. Now obviously if there's an accounting, there's ways around that, but it's not as simple as giving a very a nice simple answer on this webinar. Unfortunately, it is a complicated area. There's a mountain of legislation that needs to be covered in order to make sure they're right. And probably one of the areas I think is most dangerous is where we see people just issue dividend access shares that are on issue in their company already, without taking into account this, 7, 8, or 9 different areas of the tax legislation that need to be covered when talking about implementing some sort of strategy like this. And if discovered, it can lead to significant tax for people if they haven't covered off on all of those areas. Obviously, if any of that is of use to your clients, or you've got clients in structures that could benefit from this asset protection, we would look at their circumstances and advise them, what all of those risk areas are, and how we attempt to cover off on those to make sure that risk is minimised. Thank you for all the questions as they've come through. There will be a feedback survey at the end of this. We do have one more session on our asset protection focus, which is next month, and will be given by Kate Chalker from the Sydney office. And we hope you join in then. As I said, the feedback survey will come out this afternoon. Please let us know what you thought of today. Other than that, appreciate your attendance, and we'll see you next time.